Ever wondered how a financial powerhouse maintains double-digit growth even when the market gets tough? Today, we are breaking down the Q3 FY26 performance of Cholamandalam Investment and Finance, also known as Chola, which recorded an impressive 17% growth this quarter. Chola is currently managing a massive 2.27 lakh crore in total assets, marking a 20% year-over-year increase. Their profitability is equally strong, with a profit after tax of 1,288 crore, up 19%, and a healthy net income margin that has expanded to 8.0%. To reward shareholders, they have even declared a 65% dividend at 1.30 per share. Looking at the financial flow, Chola generated a total income of 7,985 crore. By reducing their cost of funds to 6.7%, they achieved a net income of 4,342 crore. This 23% surge in net income was driven by lower finance charges and higher fee income, eventually leading to a final PAT of 1,288 crore. The lending momentum remains powerful, with 29,962 crore in new loan disbursements, a 16% increase. Total assets under management reached 2,27,770 crore, showing that the company is still scaling rapidly despite a high base effect from previous years. While vehicle finance remains the primary engine, making up 74% of the portfolio, Chola's diversification strategy is in full swing. The growth story is now shifting toward high-growth areas like loan against property and a dedicated focus on affordable housing. Vehicle finance continues to be the core engine, generating 4,212 crore in revenue, up 16%. Growth here is fueled by demand recovery in heavy and light commercial vehicles, maintaining a healthy segment margin of 18.0%. The non-vehicle segments are scaling aggressively, with superior margins. Home loans saw 27% growth with an 843 crore in revenue, while loan against property surged with a 31% AUM growth and a high yield margin of 35.3%. Efficiency is a major theme this quarter. The net income margin rose to 8.0%, the costs-to-income ratio improved to 39.1%, and the company delivered strong shareholder returns with a return on equity of 19.1%. However, it hasn't been entirely smooth sailing. There was a slight hiccup in asset quality as gross NPA rose from 4.00% in September to 4.63% in December. This rise is primarily due to seasoning in newer business segments, but the company is maintaining a conservative provision coverage of 43%. The balance sheet remains rock solid, with a net worth of 27,577 crore, an increase of over 22% year-over-year. With total assets at 2.28 lakh crore, the debt-to-equity ratio remains at a comfortable 7.17 for an NBFC of this scale. Capital levels are healthy, with Tier 1 capital at 14.21% and a total capital adequacy ratio of 19.16%. This is well above the 8% regulatory requirement, meaning Chola is ready to fund future growth without the risk of immediate share dilution. One of Chola's biggest competitive advantages is their rural moat. A staggering 92% of their locations are in Tier 3 to Tier 6 towns. This provides a defensive edge, higher yields, and much lower competition compared to urban-focused peers. To stay objective, analysts are watching a few red flags. Net credit losses spiked 37% year-over-year, and there was a marginal rise in Stage 3 assets within vehicle finance. There was also a one-off 64 crore impact from asset sales in the home loan segment. When weighing the risks against the rewards, the positives are strong: 20% AUM growth, expanding margins, and low cost of funds. These are balanced against rising GNPA and interest rate volatility. Overall, the stance remains constructive. Chola's rural dominance and strong growth outweigh the slight asset quality hiccups, proving it remains a diversified compounding machine. If you found this earnings deep dive helpful, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.